Welcome back to the Old Fashioned Real Estate Show. My name is Jeff Holst, and that
Brian Leverage.
Correct, Brian Leverage. And I love how you always get your own name right, well, at least most of the time. So today we're going to talk about something that one of our previous guests, Brandon Turner, actually named called BRRRR Investing. B-R-R-R-R-R-R. I think there's like 10 R's there. I'm not sure exactly, but we're going to talk about that. We're going to share what those B's and R's actually mean, and why we think it's still a good investment strategy in spite of its kind of difficulty in the current market environment. And we're going to do that right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
And we're back.
We are. So, Brian. That's right. Or Brandon.
Yeah.
Brandon, I know you're a big fan of the Old Fashioned Real Estate Show. You've told me that many, many times. So be sure to put some comments below.
So what's it stand for, Jeff?
Buy. That's the B.
Yeah.
And then R is rehab.
Right.
And then refinance.
Rent first.
Oh, rent. Yes,
Yeah.
Rent. And then refinance.
Refinance.
And
And
then
I think reload or something.
Repeat.
Yeah.
Yeah. So the basic strategy is this. You buy a asset that maybe needs a little work, right? You purchase it, so buy. Then you refinance, or what? No, then you rehab it. So you rehab it. You get it up to the standard that you want. You rent it out, and then you refinance it. You get your capital back, and then you repeat. So this is a strategy that allows you to scale without having to do some complicated partnerships, without having to get capital injections from other sources.
Yeah, you can repeatedly recycle your own capital, or a partnership's capital for that matter too.
And you can do this in single family houses. You can also do it in apartment buildings.
Yeah.
You can do it across the whole thing. In fact, a lot of what we do with our value add apartment investing is a function of that. We're buying a building, we're fixing it up, we get the rents up, we're forcing appreciation, we're refinancing it, taking that capital and using it to buy something else. That kind of strategy can work really, really well. And it's also a really good strategy for kind of a newer investor.
Yes.
But there are some challenges. So, Brian, why don't we talk about why we're seeing a little less of this now? Like, in your opinion, why do we see less?
The biggest reason, in my opinion, is price. You know, BRRRR sort of became pretty popular coming out of the last housing recession we had, right? Back in...
Sure, probably like 5 years after that, right? Like 2013, 2014 is really when you started hearing
But even back then, right, you could still find a not insignificant amount of foreclosed houses in most every market, you know, which meant you could buy for pennies on the dollar, etc. Well, that's all gone, right? All that inventory has been sucked out of the system, and
the vast majority of that is definitely gone.
And now we've seen, you know, price appreciation nationally pretty much every year since then, right? And so the key with BRRRR is typically that you're buying it for a fraction of its after repair value.
Yeah.
Right?
So we'll give an example, right? I did the first BRRRR I ever did was this duplex that I had that we later sold, but the duplex I bought it for $58,000. Right now, when I sold it for $215,000, there was obviously a pretty good margin there. We put about $30,000 into renovating it. We were able to refinance that. So let's say we had $85,000 into it, I think, around there. When we refinanced it, we got a loan for $85,000.
Yes.
So I essentially got every dollar that we put in back. And then I could use that money to go buy something else. In fact, I bought my very first apartment building with that money, right?
Yes.
Now, that deal worked really well because at that time that duplex was probably worth $130,000, $150,000 fixed up, and I was able to get into it cheap enough that by the time I bought it, renovated it, I was only borrowing 60 or 70% loan to value in order to actually get that loan. And at that time, banks were willing to do that, and that's actually one of the secondary reasons why we don't see this as much, is banks typically, even then, wanted to see you have some skin in the game. But there were exceptions to that. And there are exceptions to it now, but it's much, much smaller. A lot of times what we're seeing now is even in a BRRRR situation, they're wanting you to leave some significant capital in.
Yes.
Now, that's okay if you buy a property and you get 80% of your money back, and you're able to reuse that 80%. It's still BRRRR. It's just not a pure BRRRR.
You won't have as much to get. You're going to lose a 20% margin.
If you do that every single time, you can do about 5. Yeah, and you're BRRRR'd out.
Probably really 4, but
And then you're BRRRR'd out. That's what we call that.
So, there's the bank hesitancy or lender hesitancy, and again, which is a function because they typically think what goes up must come down, which is also market-driven thinking. I mean, we haven't really seen much of a decline in price where we're at here. That has happened in other parts of the country, though. And so, when they've lent out, everybody, the basis, right? The rehab plus the acquisition, the investor, the owner doesn't have any skin in the game anymore. They're just not.
No, the banks are
it's just not good business from a lender's perspective.
Yeah, and I mean, we can argue about whether or not lenders are right about that.
Yeah.
Because I personally feel like my skin in the game is my debt, right? Like if I owe $100,000 on a property, and that's the only money that's in it, I still have to pay that $100,000 off. Right. But banks typically want to see some actual cash from a different source in there because it lowers their risk.
Exactly.
And it increases the likelihood that I'm going to want to pay. Because if I have $150,000,
you're not going to walk from your own money.
Yeah, I'm not going to be like, just take it away. Take the property. I don't want it. No, I want it if I'm desperate enough, right? Like that happens. But there's less likely, and that's why the banks are looking at that. But the strategy does still work. I mean, just yesterday, I went to a real estate event where someone was talking about a deal that they did this year where they were able to BRRRR. They bought a property in a suburban area. They got it from a wholesaler. So they got a pretty good deal on it. They were able to buy it below market. They fixed it up. And they were able to refinance and pull back all of their capital and use it for the next deal.
And track record matters here too. That's the other
For
thing,
sure.
right? If you've got an established history of doing this, and it doesn't matter, again, like you know, with whether you're doing it with houses or whether it be with apartments or other, commercial assets, etc., lenders are going to be more likely to lend to people with a proven track record. Right?
For sure.
If you're just walking in to do your first deal now,
yeah,
it can be a little difficult.
And the track record is going to be like, do you have the ability to complete the renovations? That's part of it, but also do you have experience managing properties? Because if you're a house flipper and now you want to BRRRR some properties, you might get the deal done, but they're probably going to want to see you to leave some real money in that deal. And that is another strategy. I mean, it's not technically BRRRR, so it's a little off topic, but I would call it the flip buy strategy, where you basically flip a couple of houses and then you use that money for your capital injection. Right. So even if you can't do a BRRRR right now, like a pure BRRRR, because you have to leave $10,000 or $20,000 in every deal or $50,000 in every deal, if you can still find good deals, you could flip a couple of them, generate that source of capital, and then leave that in the deal that you want to keep.
And even if you're somebody with an established track record, with the rising rate environment we've seen the last 18 months or so, debt coverage ratios are more challenging now, right?
Yeah.
Because the banks are gonna look at your, on a house, they might say 30% expense load on something like that, right? So you're getting $1,000 a month in rent, you've got $700 to make your mortgage left, right?
Yeah.
Your NOI. Now the problem is on a 7% loan on $100,000. I mean, you're actually
$7,000 a year in interest, and then you're amortizing some of it. You're not going to actually have enough money coming in
that doesn't cover
to pay the loan.
Yeah, and they're going to want to see you cover just a 1-to-1 ratio, but another 25% above that.
Yeah, I mean, all banks have their own numbers, but 20 to 35% above that. And just to be clear, the debt service coverage ratio is what you're talking about, is literally just that. It's the net operating income divided by the payment. Yeah. That ratio needs to be 1.25, 1.3. or the bank's not going to loan, but frankly, or you don't want to borrow the money because you're going to have mistakes in there, right? There's going to be things that happen, and your projected debt coverage ratio is kind of like a pro forma. It works when it works, and it doesn't work when it doesn't work. And so you want to have as big of a debt coverage ratio as possible. And in a lot of the stuff that I'm doing now, we're trying to get like a 2.0. Like we're double the money coming in after expenses than the loan payment, because we want to make sure that we're real safe.
Yes.
If I can get 1.7, 1.8, I feel really good. If I get 2.0, I'm doing the deal all day long.
Exactly.
And that's something that I think that makes the bank more likely to loan too, which is like when we're talking about BRRRRs, if there's a really tight debt coverage ratio, they're much less likely to do the deal. They're much more likely to require you to leave some of your own capital in, which is going to increase the debt coverage ratio. It's also going to lower their risk because you're less likely to walk away. But if you get a really good deal and maybe you're able to borrow at 50% loan to value and it's going to have a 2.0 debt coverage ratio, these portfolio lenders, they're going to make it work.
Yeah.
They don't care as much. They feel pretty good about that. And so the BRRRR strategy still works. Still a great way to make money, but you might have to incorporate some additional strategies, do heavier value adds, get better at finding deals, or figure out a way to inject some capital and leave a little bit of money in.
Exactly.
All
I
right.
think that about covers it.
I feel like it does, Brian. So thank you for watching the Old Fashioned Real Estate Show. If you're liking our content, be sure to give us the thumbs up and also subscribe to the channel. Thanks so much.